British American Tobacco is down 21% over the last year towards its 52-week lows with a yield of just under 10%. Is it a buy now? Is it undervalued? And today we will dig deeper into their revenue, their top line revenue, their bottom line net income, also having a look to see what we expect for their 2023 annual report. We're going to look at the health of this company, total cash versus total debt, which will go hand in hand with their dividend safety. We're going to see how well they've performed versus Altria Group as well as a few others over the last 5 years. We'll touch upon their 45 score borderline safe dividend safety and look at some financial metrics. We'll see whether any insiders are buying or selling this company, as well as seeing what the institutions have been doing over the most recent quarter. And as always, we will run them through the valuation model, getting to the intrinsic value as well as the acceptable buy price, incorporating our margin of safety, and having a quick look to see what Wall Street are forecasting over the next 12 months. So let's jump straight into it. So we did discuss it is down heavily, and if you have been holding this over the last 10 years, without including those dividends, you would be down 38%. We can see its all-time highs at around $73 quite some time ago. Now, in terms of their top line, what we like to see, 3 to 7% growth year on year, 31 billion reported in 2018, 33.4 in 2022. Now, there hasn't been great growth over the period, doesn't amount to the 3 to 7%. On a more granular level, we see an increase from 2018 to 2020 before a decrease all the way to 2022, and we are expecting when they do release their 2023 annual report to see a revenue growth to around 35.8 billion. So yes, there is growth over the last 5 years, but it is very inconsistent. Bottom line, 7.7 billion. 2022, 8.1 billion. So yes, again, similar to the bottom line, there is some growth. But then when we look at a granular level, we do see it did drop in 2019. It did then pick up in 2020 and 2021 before falling. And we are expecting a nice increase to their trailing 12 months, their 2023 annual report of 11 billion. So yes, there is a lot of positives. There are some things that just to take into account, but there are growth over that period. Now, in terms of their total cash versus total debt for a quick health check, 3.5 billion in 2018, 5.2 in their latest report. So they are holding on to more cash than they did 5 years ago. Numerically and directionally though, what we do note is that their total debt has reduced 60.6 billion to 53.5. So very positive. Whilst their cash has increased, we are seeing their total debt also decreasing, which is a very positive thing to see, especially from a company that does hold a fair amount of debt. In terms of comparing them to some in the tobacco industry, we have Altria Group, which we did just review on the channel, Japan Tobacco and a few others. Over the last year, we do see BTI down 14%, including those dividends reinvested. So they are one of the worst performing in the industry. When we maximize that to the last 5 years, BTI, in fact, one of the best performing, up 35%. But again, do bear in mind that isn't that great on a 5-year return. But as always, past performance is never really an indicator for future performance. So let's take a look. Now, we did look over the last year to see whether there was any insider buying or selling for BTI. Currently, we don't see any, so nothing to comment on that. In terms of institutions, well, we do see around 1.4 billion worth of sales by these institutions over the last 12 months. And we can note over the same period, roughly the same buying and selling. But when we look in terms of the quarters, we do see Q4 more buying than selling. The same story in Q3. So in the more recent period, institutions have been buying more shares of British American Tobacco. But as always, we don't rely on what institutions do, and it is just one layer of research. Dividend safety then, 45. It is borderline safe. Market cap, 66 billion. It is a large cap company. In terms of recessionary metrics, well, they increased the dividend during the last recession, above average growth at 5%, and they also outperformed the S&P negative 31 versus the S&P's negative 55% return. In terms of dividend growth, well, last full year at 1%, last 5 years looking positive at 4%, as that is essentially keeping up in line with inflation. Last 20 years at 10%, also looking very positive. One thing to note that this is a company headquartered in the UK, therefore they are paying in British pounds and you will see some FX differences. Dividend growth streak, well, they are 2 years away from becoming a dividend aristocrat. In terms of dividend yield theory, well, we have a double sign of undervaluation. The yield 9.43 above the 5-year average of 7.46, and the forward PE 6.2 versus the 5-year average of 8.6. On top of that, the sector P for consumer staples is significantly higher at 19.2. As always, we do ignore earnings data. It is susceptible to manipulation by management through accounting. So on the free cash flow, below 85% for tobacco companies. Very positive to note, over the last 7 years, it has been well below 85%. 2022, 50%. 2023, expected 51%. 2024 as well, 57%. So their payout is at a very, very reasonable level. In terms of the free cash flow per share, well, it has also increased, in fact, more than 2 times. 195 in 2013, 432 in 2022, and we are expecting an increase to that in 2023. In terms of sales growth, well, interestingly, with tobacco companies, we do see it remaining fairly flat, similar to Ultra. So BTI does look fairly positive given the last 6 to 7 years, although we do note it was flat in 2020 and 2021. But when we look at 22, 8%, 2023 expected 7%, that is some very positive signs that they are not only keeping up in line with inflation, but also having some real terms of growth. Numerically then, we can see they have nearly doubled the top line, 15 billion to 28 billion. Shares outstanding, well, they have done share issuances, so they have diluted your position. As we can see, 1.91 billion in 2013, 2.25 in their latest report. So something just to bear in mind, your position will have been diluted as a shareholder, whereas when we did analyze Ultra Group, it was the opposite. They had done share buybacks. ROIC as well, not the greatest. Personally, as always, 10% or more, so we have faith management are able to effectively allocate their capital. They haven't really got to that stage over the last 6 years, although we do note 2023, 10% does look a lot better. If you remember when we reviewed Ultra, they had some very, very strong, consistent double-digit ROIC figures. Operating margin, very nice to see, well above the minimums consistently on both the operating and free cash flow margin side. So there are lots of positives to take from the efficiency and how the business is run. Net debt to earnings before interest, tax, depreciation, amortization. Remember, balance sheet strength as well as dividend safety comes out from this. 2.96, the number of years it would take BTI to pay off all of their debt net of cash on hand. It is below the 3 maximum we look for. Positive to note, in 2023, it is expected to be lower as well. So based on this information, as well as the free cash flow payout, the dividend does look to be safe so far based on this information. Let's jump into the valuation model. As always, if you do enjoy the content, values being provided, smash that like button, hit the subscribe and bell button so you are continually notified of these videos as they drop. Before we jump into the valuation, just to let you know, we have started a free weekly newsletter. Last week, we did talk about undervalued companies with strong upside. All you have to do, click on that pinned comment below to sign up, completely free, and you will receive one a week. The week before that, which you can also grab, we talk about the 7 golden dividend metrics to identify undervalued stocks. So let's get into the valuation. Now, running into Graham's valuation, we have the earnings per share, the growth rate, and the AAA yield for corporate bonds. Intrinsic value coming to $51, so we have a big sign of undervaluation. As always, though, do bear in mind we don't look at any of these in isolation, and we will draw conclusions towards the end. We then have the multiples valuation, companies in a similar sector and size. Average P multiplied by BTI to get an intrinsic value, $62, more than 100% upside, so a second signal of undervaluation. We then look at the DDM, dividend discount model, with the growth rate year on year. Now, 2.23%, this is just the FX. They didn't have a dividend cut, but as I mentioned, they do pay out in pounds, so it really depends on that FX rate. So forward looking, we have gone lower than the average, which was around 4% at 2% here. This gives an intrinsic value still showing strong signs of undervaluation at $48. DCF model, then the free cash flows year on year, negative 4%, a bit more conservative than analyst estimates. With that discount rate, we get the present value of future free cash flows and terminal value. Add together with their cash, subtract total debt, get to the equity value, divide by shares outstanding, we get an intrinsic value of $43. So we have 4 signs of undervaluation for BTI in today's episode. And don't forget, you can click on that pinned comment below if you want to grab a copy of the valuation model to get to the intrinsic value and acceptable buy price of companies in your own portfolio or those on your watch list. So we start off as always with a 10% margin of safety, which we use if we believe it has a wide moat, strong financial metrics, good forward-looking data. And we keep going until it turns into a sell signal, and we can see BTI does have a very large margin of safety. So we can see it's pretty much showing at least a 40% margin of safety. Now, this really depends the number that you use on your investment thesis, whether or not you believe the tobacco industry is dying. Their top lines are going to start to drop and even go negative. In terms of Wall Street and what they forecast, well, they have a price target of $40 with upside of 35%. As always, let me know, is this a company you have been continuing to add towards its 52-week lows with a yield of nearly 10%, or do you prefer Ultra Group, which we have just reviewed on the channel? As always, have a great day. Smash that like button if you've enjoyed today's episode. See you on the next one, and as always, have a good weekend.